Hi everyone, my name is Piterpakulski. Today we will continue building financial model for a manufacturing business idea, and today we will be modeling internal rate of return. Interesting thing about internal rate of return is that there are some built-in formulas in Microsoft Excel, but when the majority of them are used for the calculations done yearly. So you have year 1, year 2, year 3, year 4 model. But when you calculate your financial model with a step of calculations which is equal to 1 year, you are not able to calculate the accurate amount of financing, like these, for example, operating losses, like these losses. So these losses are hidden inside the year, and the first year may be positive, but in reality the first year of operating activity may contain a lot of losses, and you have to account all these losses to calculate the right amount of financing. That's why when you calculate your financial models, if you prepare your financial model with a step of a year, you may have lots of issues, and to avoid these issues you need to start preparing your projections monthly, and then you will need some algorithm for monthly calculation of internal rate of return. And that is what today I will be showing you. This is my way how I'm calculating it, because there are a lot of types of projects. So if you have some business idea, for example, when you have some investment stage, then operating stage, then inside in operating stage you have some investment expenses again, so you would better use another way of calculating internal rate of return, because you may get the wrong internal rate of return. So today I will be showing you the way I calculate it. Maybe this video will be useful for you. You may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video I will give you the link to the playlist where I will be give you all the tutorials of this model, and when I will be done with this model creation, I will give you all the links in the description of this video as well, so you may watch tutorial by tutorial from scratch. Now let's run through the model quickly. I will be showing you what we did before. So blue color is the color of inputs. So we have two products. We can switch them on and off from calculations. We have two manufacturing lines. We can switch them on and off from calculations. We can allocate the time of production, product A and product B on each line. Then we create the block of input where we specify when we start operating activity, month and year. Then we move to the block of inputs where we set up how fast we set up the speed with which we reach the target revenues from the moment when we start the operating activity. Then we assume that for each line we may have 3 shifts. We can switch them on and off, and we can set up the month number from the start of operating activity when each shift appears. Then we specify the amount of hours in one shift. Then we go and specify the amount of work days inside each month, inside the typical year. Then we start talking about raw materials. Here is the raw materials library, and then we specify what raw materials play part in production of in manufacturing of product A and product B. Then the investment. And here we specify
what we invest in, when, and how much before we start the operating activity.
Then we move to payroll for line 1 and line 2, depending on how many shifts we work daily. Then we move to payroll, which is fixed, and it is not linked to the shifts. Then we move to direct payroll, which is linked to the amount of units produced of product A and product B. Then we start moving to the revenues. So we assume that we have for product A and product B, for each product we have 3 types of customers, and each type of customer has its own price, selling price, and they pay us different way, and here we specify how they pay us. Then we move to electricity costs. Then we move to the direct cost linked to the amount of raw materials needed for the manufacturing process. Then we started working on direct costs linked to the amount of shifts we have monthly for line number 1 and line number 2. Then we talked about pallets, packaging costs. Then we were working on fixed costs. Then we started working on loan modeling. Then we created cash flow statement, calculated the amount of financing needed. Then we calculated payback period, profits and profitability. Then we were talking about discounting. We calculated discounted payback period and discounted and net present value. Then we were modeling loan coverage ratio. Then we had a tutorial about different types of profitability. And now we are moving to the internal rate of return. So let's name this tab model. And here we're gonna add a new tab. We'll call it internal rate of return. So here, first of all, I will put what I need to put. I will put the discount rate. Let me do the following. I will do this. Format cells, number, so this will be percentage format. What we're doing now, this cell is no longer an input, so we will map it here. Then let's change the color because it is no longer the input. Then here I will place net present value. the net present value I will put from here. Then I will put here internal rate of return. So here this will be a percentage value. And now what I will do here, I will create a table. So this will be a starting, so this will be the list of discount rates. Discount rate step. The discount rate step will be, let's say, 1%. Let's add some lines here. So first of all, we will create, so here we will put the net present value. Here I will be putting the discount rates. Now let's extrapolate this formula down. So for example, let it be here. And what I will do now, so now I'm gonna select this table. Let's go up. Now let's use data. Let's go to data. Then I will be using what if analysis, data table, and here in column input cell I will put the discount rate, and then I will press OK and magic will happen. So here we can see the values of net present value of this or that discount rate. So for 15, this will be this value, this will be this value, and here we can see when positive turns to negative, so this is somewhere is the discount rate in our case. We can, for example, adjust the step of changing the discount rate, for example. and see the story more accurately. And for example, we can start with 45%. And do like this, for example. So now we need to find the moment. When this positive turns to negative, and this will be our internal rate of return. It is not 100% accurate, but it doesn't give us a 0 in net present value, but this is more accurate comparing if we are calculating monthly and our project has multi-stage, for example, multi-stage environment, when we have multiple investment stage. So usually when people are showing net internal rate of return calculations, they for example show the story when we have 1 year of investment, and then cash flow of year 1, year 2, year 3. Here we can be absolutely flexible. We just going discount by discount rate, and we can see what net present value coincides with this discount rate, and when net present value starts being negative for the first time, this will be the internal rate of return. So this way of calculation of internal rate of return calculation is more safe in some ways. That's why I'm using it. So now let's calculate the internal rate of return. Let's find it. So for example, if this value is less than 0, then we put 1, otherwise 0. Then the next formula will be if this equals to 0, if this equals to 0 and this one more than 0, we will put 0, otherwise. If this one equals to 0 and this one is less or equals to or less than 0, then we put 1, otherwise 1. Now we're closing brackets. Now let's extrapolate this formula to the bottom. So here we can see when 1 appears for the first time. Now let's find the moment when positive becomes negative for the first time. So if this value equals to 1, we will put this discount rate, otherwise 0. So this will be percentage format. So then if and this value equals to 0 and this value equals to 1, I will put I will put this value, the value of discount rate, otherwise 0. Now let's extrapolate this formula to the bottom. So here we can see the discount rate when net present value becomes negative, the closest. Then we just need to create a total for this column. So this is the discount rate, which gives us negative net present value. Then we are putting this internal rate of return here. We are just Ctrl X, Ctrl V. And now, for example, we can go to the model, and for example, we can decrease the pricing and take all the pricing 8% of our basic scenario pricing. So we will take just 80% of prices that we had at the beginning. So now we can see how the internal rate of return changed. We can go back, we can go at this line, see the moment when net present value changes from positive to negative. So this is the internal rate of return. And now we can put this value of internal rate of return to our financials. And now we can adjust the inputs the way we want. We can play with this value, we can play with this value, we can play with discount rate itself, and see what will happen with the internal rate of return. So this is the way I usually calculate internal rate of return. I hope this video was useful for you. You may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video I will give you the link to the playlist where I will put all these tutorials, and when I finish this financial model I will place all the links how I created this model from scratch in the description of this video as well, so you can watch all the tutorials from scratch. So I hope you enjoyed this video. Like, share, subscribe. See you guys in next videos. Thank you and bye.